He must be going somewhere, and I'm not crediting this to the president or not crediting it to him. I am saying, though, that the pickup in economic activity, which seems fairly broad-based, is that all a bubble to you?
Yeah,
I mean, I can see what you're saying about some technology, although you lump a lot in with Amazon. I'm just wondering whether you're being fair to the overall economic performance today.
Well, what we had, one quarter of 4%, 4.2%. It was an anomaly. It was a pull forward of exports around the world. They see the
So you think it's going to be a lot slower this quarter?
I think it'll be down this quarter. There's huge inventory building, but you know what happens?
The Atlanta Fed, not that it's always reliable, disagrees with your prediction.
No, it's been wrong more often than right.
Well, the Atlanta Fed says David Stockman's right.
Well, look, in the 6 quarters that Trump's been in, you can't take one quarter annualized
with
all these aberrations.
But wait a minute. What is going to bring this crash to you?
Old age, debt. We have $69 trillion of debt on this economy, public and private, compared to $52 trillion before the last crash.
Bull markets never die of old age, though. Something else jostles them. Well, what will jostle?
3 things. The trade war is absurd, and it's going to have far bigger repercussions. I think he's going the full Monty. $500 billion of imports from China that go into the everyday, purchases of American households. Those account for 30% of the goods in those categories. China sets the price, raise it by 25%, and everything's going to go up. It's the marginal price. So we're talking.
We have the option not to buy that stuff.
Well, you're going to buy it from somebody else, and they're going to pay. They're going to,
So for holiday sales, there could be problems. For consumers,
hundreds
there could be
of billions of additional costs.
So trade. I want to be clear. Trade is going to be an issue.
Number one, the fiscal collision coming is out of this world. It's not the interest rate is the real issue with the Fed. It's they're shrinking their balance sheet finally after this absurd, 8-fold increase in the last decade. So they're taking $600 billion of debt they own today, treasuries and Fannie Mae's, and they're dumping them back into the market. And that means that's called QT. That's called shrinking the balance sheet.
Right.
At the same time, the Treasury will borrow in the year we're in $1.2 trillion, crazy, 6% of GDP at this late stage of a business cycle.
So interest rates can only go up.
Interest rates can only go up, and if we had a shock in the market at 3.25 on the 10-year, we're going to be over 4%. Soon.
But what if that's a premature shock, that it might be jolting, but cooler heads will prevail every other time?
No, because...
let's say, believe me, I'm no horse in this race. Early February, whatever this year, when we had something similar going on, it ended up being short-lived, and people pounced right back into the market. What makes you think that this time won't be different?
Because, for one, this is a massive bubble that can't be sustained. The market, even after this correction, this S&P is trading at 22 times its current gap earnings. Now, that may be good when you're just coming out of a recession.
18 times forward earnings.
Yeah, well, those are hockey sticks. I know, Neil, but those are hockey sticks.
They're not a lot rich.
No, they're terribly rich.
Hear me out. And you were there for the 87 experience with Ronald Reagan. We had much richer multiples then. Now, to your point, we had growing concerns that we were ignoring prior to that about what was going on abroad. Also, to your point, we have signs that is festering, not only what's going on in Asia, Chinese market down 1/3 from its highs. European markets, at least 4 of them in bear market territory. Italy is falling out of bed. Is that the catalyst here? Well,
I think the key thing is there is no one multiple size that fits all.
Right.
The key thing is when you're in old age in a business cycle, nobody's abolished recessions, you don't pay 22 times current earnings or 18 times forward because the likelihood is in the next 2 years we'll have a recession, earnings will drop from 122 to 75. The market will go through a 30.
When you say 122 to 75, what are you talking about?
$122 per share on the S&P 500. They always drop 40% in a recession. The next stop is $75. It's not 160.
You could argue these higher rates all of a sudden change the math on those earnings, on those multiples in a good way.
No, no. I mean, rising yields cause multiples to shrink. And the argument we've been hearing for years.
But that's my point. I mean, there could be a lot of people look at that and say all of a sudden this doesn't look like a rich market to me, or as rich.
No. The multiples are way too high already. And as interest rates go up, the multiples have to shrink, and therefore the market stock prices are going to go down.
But you could make, all I'm saying is there are a lot of people who seize on this meltdown or whatever is going on to say it is depressing these stocks, it is depressing these earnings to the point where the price and the earnings are a lot more favorable to investors. You're saying that's not going to be the case.
No, I'll tell you why. In 2007, before the last crisis, on the S&P 500, interest cost after tax was $50 a share. The Fed drove interest rates down in the basement. Trump was right about that in the campaign. Last year, the cost after tax was $19 a share. I will tell you that it's going back to $50, and that $30 of per share of additional interest cost isn't factored in at all.
All right. You worked with Ronald Reagan. His view of the markets versus this president's view of the markets.
Totally different, okay? He didn't confuse himself with the Dow Jones average. Ronald Reagan understood what capitalism was about, and that was happening because people out there in America were getting bullish. They were believing he was turning around the economy, that earnings prospects were getting better, that his tax cut had made a difference. Today, Donald Trump is a massive egomaniac who thinks, the stock market is a referendum on his brilliant leadership when it's going up, and it's somebody else's fault when it's going down. He is a dangerous man. He's dangerous on trade. He's dangerous on this deficit. And the last thing we ought to be doing is attacking the Fed when they're finally getting enough gumption to get interest rates to some kind of normal level and to shrink their balance sheet and get their big fat thumb out of the stock market and the bond market and let capitalism do its job.
There you go again, David. All right. The man who was taken to the woodshed speaks his mind. Did back then. You could agree or disagree, but he does make you think.